Welcome to the Deep Dive. We're your shortcut to understanding what really matters in the source material. Today, we're tackling something maybe a bit unexpected. Our sources, an earnings call, believe it or not, and the financial backs that came with it. We're looking at AIA Engineering Ltd. They're a huge global player in a really specific area, high chrome mill internals. And our mission today, it's definitely not just about crunching numbers from a balance sheet. No, we're here to unpack a really deep, fundamental strategic change that's going on. This company, they're the world specialist in wear parts. Think heavy-duty grinding stuff, liners, the things that keep the mining sector's industrial heart ticking.
That's right. And if you just scratch the surface of their Q2 and half year results for FY26, that's the period ending September 2025, you see something way more interesting than just, healthy profits. These documents, they really lay bare a dramatic pivot. AIAE is consciously moving away from just being a product supplier selling grinding media like it's a commodity. They're repositioning themselves as a very sophisticated integrated solution company. They're essentially selling engineering efficiency, and they're selling it to some of the biggest, toughest, most frankly conservative mining giants out there.
Exactly. So here's how we'll structure this guide. We'll use the financials, which are pretty stable, as our base. First, a quick look at the company's health in the first half of the year. Just get that baseline. Then we'll really spend our time digging into that core strategic shift, this solution engineering idea, and how it's actually leading to some game-changing wins in critical markets like South America, which was pretty much off limits before. Okay, let's start with those H1 FY26 financials. Operationally, things look solid. Sales volume for the half year came in at 123,315 tons. That's up just a bit from last year's first half, which was around 121,000 tons. Q2 specifically was 63,159 tons. For the quarter itself, the top line was 1,029 crores. For our listeners, that's roughly, $124 million USD. And that generated a profit after tax or paid pay of 277 crores. Pretty healthy.
Yeah, but what really jumps out, I think, is the margin performance. The EBITDA margin was quite high. It hit 37.76% in Q2, and for the whole first half, it was 39.11%. Now, this is where the management commentary is absolutely key. They directly attribute this strength to an, and I quote, extremely favorable product mix, and this gives us some really critical context for you listening. Don't expect this 39% margin to be the new normal forever. Management is sticking very firmly to their long-term guidance. They're saying expect a sustainable operating margin more in the range of 20 to 22%, maybe 24 to 25% if things go really well on the optimistic side.
Okay, so margins are high now, but the long-term view is lower. What does that actually tell us about where the strategy is heading?
Well, it tells us a couple of things, really. One, right now, they're clearly selling a really rich mix of high-value stuff. Specialized castings, liners, that kind of thing. Two, they know that the big volume growth they're chasing, that 30,000 tons we'll talk about later, that's mostly going to be the slightly lower margin grinding media. So naturally, the overall blended average margin will drift down. Still very healthy, mind you, but lower. It also kind of signals that these current high margins, they aren't really coming from the main growth strategy yet, the one that involves those really long, 2-year conversion cycles we need to get into.
Right.
And speaking of operations, capacity is 460,000 tons per year, TPA, but utilization is only around 55–60%. So lots of headroom. They're also sitting on a huge pile of cash, about 4,500 crores, which is over $500 million US. And working capital looks okay, receivables around 72 days. I did want to touch on that restructuring they mentioned kind of quietly, the confirmed closing their Nagpur unit and the well-cast steels factory. It wasn't presented as a huge deal, but it feels important. Why shut down plants now? Consolidation.
Oh, it's absolutely significant. And I think it ties directly into this whole solution company strategy. Yes, they mention viability and location issues, but think about it. When you're selling a complex, engineered, high-value solution, quality control is everything, utterly paramount. You need your manufacturing consolidated in top-tier, high-tech facilities. So this restructuring, it really suggests they're streamlining their production footprint, making sure they can guarantee the absolute highest quality for these custom-engineered components. That directly supports the value proposition of the new strategy, right? They're prioritizing that tight quality control over just having plants spread out everywhere.
That makes a lot of sense. If you're selling the whole system, you need total control over every piece, not just shipping a commodity part. Which brings us perfectly to that core strategic shift. The earnings call documents are quite clear about the risks of just being a product seller.
Oh, absolutely. Selling only grinding media, it's a brutal commodity game. You're facing constant, intense price wars. And you're super vulnerable to trade protectionism, things like tariffs and duties. The documents even explicitly call out the U.S. duties that hit them in June 2025, a countervailing duty of 3.16% and an anti-dumping duty of 6.91%. I mean, those are massive hurdles. They force you to compete purely on cost.
So the need to pivot seems pretty clear then. Get out of that commodity trap, especially with these trade barriers and duties popping up. But maybe for our listener who isn't, deep in the mining world, could you clarify what these products even do, and why is high chrome so central to this new liner-driven solution thing?
Yeah, that's a really good point. So picture mining. It's basically about grinding up enormous rocks constantly, 24 hours a day, 7 days a week. The grinding media, those are the heavy balls inside the giant rotating mills that do the crushing. And the liners, they're like the protective inner walls of those mills. They're wear parts. They just get worn down and need replacing all the time. Now, high chrome, that specifically means these parts are made from an alloy that's way, way more durable and resistant to wear than traditional steel or other materials. Much tougher. And the critical value proposition here, it isn't just about the cost of the part itself. It's really about reducing the mine's downtime. Think about it. Every single hour that a massive copper mine, say, is shut down because they have to stop and replace worn-out liners or balls, well, that costs them potentially millions in lost production.
Ah, okay. So you're not just selling them tougher metal parts. You're selling them uptime. You're selling them efficiency. Makes sense.
Yeah.
Tell us about the actual solution they're offering now. What's in the package?
Right. It's this integrated package deal. It combines their top-of-the-line high-performance liners with, and this is key, new engineered design changes to the mill itself. That part is almost like a consulting service. And then, of course, it includes the high-chrome grinding media balls. So they're completely shifting the conversation. It's not how much per kilo for grinding balls anymore. It's how much more throughput, how much more valuable mineral can we guarantee you'll get out of your entire mining operation by using our system.
Okay, let's break down those benefits. They mentioned 3 specific ones, right? Using their numbers.
Yeah, and they are pretty staggering when you look at them. First, okay, yes, you do get some straight cost savings on the consumable parts themselves. Maybe they estimate 8–10% of the total mining process cost, which is nice. But the real kicker, the real leverage, comes from points 2 and 3. Point 2 is significantly increased throughput. That means the customer literally gets more valuable copper or gold out of the ground using the exact same facility. The documents give an example. A customer might spend, say, $5 million to $10 million on AIE's solution package. But the resulting improvement in their annual throughput, the value of that extra mineral, that could be worth $25 million, maybe even up to $50 million.
Wow.
Yeah. And the third benefit is substantial savings on power costs, because more efficient grinding simply uses less electricity.
Okay, that's the key leverage point, isn't it? Offering potentially $50 million in proven operational efficiency improvements for a $10 million product and service package. Suddenly, the price of the actual physical product seems almost insignificant compared to the value add.
Exactly. That's precisely the shift. They're selling high-level engineering consulting that's backed up by superior hardware. They effectively turn what used to be a variable commodity expense for the mine into a fixed, predictable operational enhancement cost. It changes the whole financial picture for the customer.
But mining companies are famously conservative, right? They don't just swap out critical suppliers overnight. If the value is this obvious, why does the sales cycle take so long?
Because you're asking them to fundamentally re-engineer the mechanical heart of their entire operation. That's a huge decision. It means months, sometimes over a year, of rigorous trials, testing, data collection, analysis, making sure the promised efficiencies actually materialize in their specific environment. The documents really hammer this point home. It takes almost 2 years, sometimes even more, to fully convince a typically conservative mining customer to make the switch. That creates this massive lag time between when AIAE starts investing time and resources in a trial and when they actually see revenue from it. This 2-year cycle, it's a huge risk exposure for them.
How do they manage expectations, say, with investors during that massive lag? I mean, if commodity prices suddenly tank, or the global economy slows down 18 months into a complex trial, couldn't that whole effort just evaporate?
That is the absolute core risk baked into this entire strategy, no doubt about it. They try to mitigate it partly by having those steady existing revenues from their traditional business, the ones we looked at in the financials. That provides a cushion. But ultimately, they are banking everything on the proven success of the solution itself. Every single conversion they manage to achieve, like that big one in Chile we need to talk about, becomes massive validation. It proves to the next potential customer that the efficiency guarantee is real and that it's worth the huge investment of time and risk from the customer side, too.
Okay, let's get to that tangible proof then. The evidence that this long, risky 2-year cycle can actually pay off. The major order they just won in Chile. This is their first real breakthrough in that super important South American market, right?
This is the moment the strategy really went from, let's say, theory on a PowerPoint slide to hard reality. It's a big deal.
Yeah.
They didn't name the customer privacy reasons, apparently, but the details they shared are exciting. Critically, this marks the first time any customer in that whole region is using their specific, high-end, hyper-branded grinding media. The contract itself, it's for 18 months. Total volume is about 22,000 to 23,000 tons, and it's valued at around $33 million USD. That translates into an expected annual run rate of about 15,000 tons once it's fully ramped up. And the first shipments are actually starting pretty soon in Q4 of this fiscal year, maybe 3,000, 4,000 tons initially.
So why does one large order in Chile matter so much in the grand scheme of things for their global story?
Because it potentially unlocks the door to the entire Latin American market, LATAM, as they call it. This region, especially that major copper belt stretching through Chile and Peru, is notoriously tough to crack. And it's heavily reliant on older, traditional, much less efficient grinding media technology. The documents specifically note that this key copper belt currently has, and I quote, absolutely none, or maybe just very, very low penetration of high-chrome solutions.
Wow, so it's basically like a greenfield opportunity, but in a huge established legacy market.
Exactly that. They're targeting high-value minerals there, copper, gold, iron, where even a small percentage improvement in efficiency translates directly into massive dollar value for the mining company. And the sheer size of the potential market is staggering. The entire LATAM region, they estimate, consumes something like 700,000 to 800,000 tons of these kinds of wear parts and grinding media every single year. Management believes that if they could capture even just 20% penetration in that market over time, well, that alone would be a huge market for them. We're talking over 140,000 tons of potential annual volume just from achieving that 20% share. So this Chilean win, it's the crucial validation. It proves they can sell this complex efficiency solution in that extremely important, traditionally very conservative geographic sector.
Okay, looking ahead then, let's talk about future volume and the growth pipeline. If the sales cycle really is 2 years, they must be aggressively filling that pipeline right now to hit future targets.
Oh, they are. Absolutely. They confirmed on the call that they are actively working on conversion opportunities, so running trials, making proposals at more than 50 different mines globally right now. And when you add up the total potential volume involved in all that prospecting work, all the proposals, all the trials currently underway, it amounts to somewhere between 200,000 and 250,000 tons. Now, think about that number. That's massive, especially when you consider their current total annual sales volume is only slightly over 240,000 tons. The potential pipeline is almost as big as their entire current business.
Okay, but 250,000 tons is potential, right? Not guarantees orders yet. How much of that massive pipeline does management realistically think they can convert into actual signed contracts in, say, the next 18 months or so? And what are the key points where these deals could fail during the trial phase?
Right. Potential is the key word. The failure points are always in the trials themselves. If the custom mill engineering changes don't deliver exactly the efficiency gains they promised under real-world operating conditions at that specific mine, well, the deal is likely dead. That's the risk. However, management sounded highly confident about the quality of their current pipeline. They specifically highlighted 2 very large mines that are currently in the final advanced stages of trial. They expect the final decisions, the outcomes from those trials, around the end of December this year or maybe into January, February of FY26. Management actually described these 2 specific situations as potential game-changer deals. They even noted that competitors across the industry are watching these trials really closely because if AIA succeeds there, it could fundamentally shift the whole industry standard towards this kind of solution model.
And based on this pipeline, which sounds robust but definitely carries risk, what's the concrete minimum growth they're actually guiding for?
Yeah, they put a number on it. They've committed publicly to a minimum expected incremental volume growth of 30,000 tons annually, and that's expected to start kicking in next fiscal year, FY27. They really emphasize that 30,000 tons is the floor, the absolute minimum they anticipate delivering based on the progress they're seeing in these ongoing trials.
Got it. And just a quick note on capacity expansion before we wrap up. We mentioned their current 460,000 TPA capacity is all in India right now. What about plans for a future global footprint?
Yeah, they touched on that. They do have longer-term intentions to set up some manufacturing facilities overseas, specifically mentioning Ghana and China, but they were careful to clarify that these would likely be smaller, more modular plants, probably designed to serve specific regional customers more efficiently, maybe cut down on logistics costs for certain contracts. But the key point for now is that their entire current massive capacity, that 460,000 TPA, remains consolidated in India, which again reinforces that focus on centralized quality control, which is so critical for this new solution strategy to work. So if we synthesize this whole deep dive, the story of AIA Engineering is really one of profound, almost necessary evolution. It's driven by intense market pressure and those tricky trade barriers. They are, it seems, successfully navigating the shift from competing solely on the price of a commodity part to competing on the integrated value and operational efficiency of a whole solution. And that big Chilean win, that's the definitive proof in the pudding. It shows this new model where they're effectively solving a client's $50 million efficiency problem rather than just selling them a $10 million product actually works, even in the toughest, most conservative markets.
Yeah, that distinction is everything, isn't it? Solving a massive multi-million-dollar operational problem versus just selling a wear part. That feels like the ultimate competitive moat they're trying to build. Historically, like you said, they've been hampered by things like anti-dumping duties and just the incredibly slow pace of customer adoption in mining. This new strategy seems deliberately designed to make those issues almost irrelevant, because the sheer value created for the customer should, in theory, far outweigh any tariff costs or the base price of the physical components. So the provocative thought we want to leave you with is this. The success of this entire model really hinges on their ability to consistently prove its efficiency, again and again, out there in the real world, at the mine site. If AIA Engineering can successfully leverage this efficiency-based model, if they can keep executing these complex conversions, especially in those highly conservative, massively underpenetrated markets like the South American Copper Belt, which is pretty much virgin territory for high-chrome solutions.
Well, just how high is the ceiling for a business that has effectively managed to make its own material costs almost a non-issue compared to the staggering operational value it adds for its customers? Keep a close eye specifically on those conversion rates coming out of the two big game-changer advanced trials they mentioned, the ones expecting results in early 2026. Their ability to turn that huge prospecting volume into actual guaranteed annual run rate, that's really the metric that will tell the story going forward.